Morning, everybody. Thanks for the introduction, Katie. We're going to get straight on with it. I want to introduce the keynote speaker, which we're going to host as a fireside chat. And it's Lance Uggla, who is the Chief Executive of IHS Markit. Lance. Yes, he is here. Thanks. Thanks. Sit down. Now, we're going to do this as a fireside chat. You'll have to imagine on a cold day like this as a nice warm fire. Now, Lance, IHS is now a $20 billion market cap company listed on NASDAQ, almost a fintech before it was even the name fintech was even a word. Let's go back right to the start, because the genesis is always an interesting question. How do you become a disruptor? How did you make yourself vital in this very strange world of credit derivatives?
So I guess disruptor or innovator, I think, are the two key words for lots of the new companies being set up in this room. And I think it was the same at the time when I set up Markit, which has become IHS Markit. And I think we were more of an innovative company, but we also disrupted parts of the financial services market in terms of going after new areas that maybe others should have went after before us.
So what was it, though, that you actually did?
Well, we didn't have words like big data, data science, AI, but if you look back in most industries, and financial markets for sure, information's needed to make decisions. And maybe we didn't call it big data, but today, really, we're using information to make decisions. The only difference is the storage and compute power has changed. We're still calculating scenarios. We're trying to predict things. We're trying to add value with information. And the idea with IHS Markit, or Markit when it was founded, was to create transparency around the credit markets, take information, produce products and services from that information that help people make decisions. But then we had a 2 meg line, we had less computing power, and it took us 5-6 hours to run the scenarios that we wanted to run. Today we do those in seconds, and of course we've got storage and compute power that's multiples of what we had 12 years ago.
So you were, to take you right back here a long time ago, you were an executive within, I think it was TD
Toronto
Security?
Dominion Bank, yeah, TD Security.
And what was it you noticed that the problem was? Yeah.
Well, post-Enron, there was a lack of transparency around the credit markets. There was also a regulatory change. And it was probably the regulatory change coupled with the lack of transparency that created the opportunity to innovate. And that was the opportunity that I capitalized on. We had a big credit portfolio. We'd collected a lot of information to produce pricing that could help us trade, and I felt that same information could help other financial market participants either trade or manage capital or risk or make decisions pre or post-trade.
So people needed the data. Why couldn't they just hand it over to each other? Why did they have to come through you? Why were you so important?
Well, of course, nobody wants to train their competitors. So the thought of handing data over on your own information and allowing two parties to see what each other are doing, that concept has never been popular, and I don't think would be today. But the idea of a broader sharing where the data is then anonymized and then distributed. That was something that had worked in equity markets, in foreign exchange markets, so why not credit markets? So that was the...
So effectively, and it's maybe to use the jargon of the day, you become a trusted third party.
That's a fair word.
It's a fair word, which is, I suppose, very interesting now that we're actually getting to the point where we're trying to create trustless networks. And that was, so from that beginning where people are willing to trust a third party with their data, and the business has continued to grow here. How do you then go from being a niche to something more?
Well, I think that's probably important to many people in the room, and it's interesting because now today we have, I don't know, say 3.8 to 4 billion of revenue recurring, and if you think of the first products, probably about 60 million, and imagine that first product's operates at a 50% margin, and when it was growing, and if it's growing in today's environment, that'd be probably worth 500 million, and you go, wow, that's a home run. But once it hits that maturity scale, it hits the top of the maturity level where it starts to grow at low single digits or just, maybe a little bit of price inflation. The 30 million of EBITDA all of a sudden is only worth 360 million instead of 500 million. And what I would caution for many is that, now we have, say, 100 products globally. Many of them they hit that maturity scale, and I'd just say if you're a one-product company, either diversify and invest your profits into new areas or innovation, or two, make sure that you're selling on the way up that curve, or you might end up taking it a bit too far. And so really what we did is we invested all the profits of the company into either building new products, which is the best way to grow, or to acquiring, which can be good if there's strong revenue synergies, but you need a combination of both.
Maybe the first one would be, so what are some of the areas that you branched out of once you came out of credit derivatives? Where did you go next, and where are you now?
Well, when you start, you always have a vision. The first vision for the company was actually definitive credit pricing. And so, of course, that had to mean credit derivatives, but then, of course, it means loans, and then followed by that meant bonds. So if you wanted to cover all the credit spectrum, you wanted to have all those instruments. And what's interesting, it was the credit derivatives piece, which was the first product, that came quick. Developing evaluated pricing and competing against the likes of Bloomberg's, Thomson Reuters, IDC, actually could have given that one up 20 times. And today we're one of the top 3 players, and it's a double-digit growth market in something that was quite mature. But the need for information has grown. The need to have multiple sources has grown. We ended up in this great position. In loans, there was only one other competitor, but they didn't have the credit derivative piece. And so when we put loans and credit derivatives together and sold those in a common feed, we actually ended up becoming the lead player in the leveraged loan market. And today we process, which was the next kind of innovation, probably 99% of that US leveraged loan market. And of course now there's blockchain, and we've got to leverage into that. And just opportunities come one after the other if you stay at the front of your game.
How do you break into some of these markets, though? I mean, when market started, the 2 big information providers in the city were Bloomberg and Thomson Reuters, and they still are the 2 biggest. Everywhere you go on a city trading desk, these big screens, you see them on the TV. And yet, you managed to get in there. Do you need to be an insider? Do you need to know people?
I think competitive edge comes a couple different ways. When I think about technology today, I don't actually think the technology's the competitive edge. I actually think the competitive edge is subject matter experts and content. And then use technology to leverage that, whether it's leveraging your experts or your content to achieve the product and service. And it's hard to beat content and subject matter experts. Technology, once you have capital, you can afford to buy it. And it's available. And you don't need to necessarily be the creator of the technology, but you better use all technology available to you, whether it's storage, compute power, new technologies like blockchain, although maybe there's a lot of hype around it now. 3-4 years from now, you'd hate to be the company that didn't disrupt themselves with new technologies if they really were going to take a role in, the transference of ownership of assets. So I always looked at Bloomberg and Thomson Reuters, and they always dislike me for saying it, but I go, it's great to be the television set, but you got to have content. You got to be the network actually is a nicer place to be. And I've always focused IHS Markit on being the network. Let's make sure we have content that whether it goes through television X or television Y, do we really mind? You know, let's make sure our content's available for everybody and through the mediums that work. And, you know, there's new mediums today. There's, you know, new technologies and startup like Symphony. There's, you know, new, you know, web-based apps and desktops. Our content goes into Schwab and E-Trade and TD Ameritrade through retail apps. So, you know, having the content or the subject matter experts, I think that's the way to build your company.
You mentioned something before about when you hit that maturity curve, you know, then you start looking around for something else. How do you spot when you're at a maturity curve?
Well, besides you stop growing and price, there's new products competing against you, and you generally feel price pressure. Those are the early warning signs. And at that point, you either need to add to your product, you know, cut price, try to get a larger market share. You've got a lot of, you know, standard textbook things that you can do to, you know, to position yourself better. But to me, I worry, you know, people look at our company, they say, you know, growing at 4, 5, 6%, but try growing, you know, 4 billion at 4, 5, 6% when 10% of your revenue disappears every year. You've got to grow that 400, plus you got to grow the 200 is 600, and then you do it throughout the whole year. If you did it on a regular basis, you're actually got to find 1.2 billion of revenue throughout the year to get 600 in year. That's a big, tall order, and actually, you know, sometimes I have to, you know, pinch myself and make sure I'm really up for that task. But it's a different thing, and so the products that are maturing, of course, are maturing and growing at lower than your target. But of course, your innovative new products should be growing at 10, 20, 30. We have products that, you know, grow at 50%, you know, or higher. So
as these mature products begin to roll off and lose revenues, right now, where's the opportunity for you? Where do you think I can get the most growth?
Well, so I think, again, I go to the basics, subject matter expertise and information. Those are the two things that I know I can monetize. And when I merged the company with IHS, I felt that being in a single industry, financial markets, having other industry expertise, more subject matter experts, and more content was actually a better way to diversify and transform the company because we all shared one thing. We had to use technology to leverage that content, and now we have the revenue opportunities that exist between the industries and financial markets participants who are all hungry for every bit of information you can give them, and that's the growth.
So if you look at it from this perspective, if you're looking at the world this way, does it matter if you choose artificial intelligence or blockchain or whatever the buzzword happens to be?
Well, I think there's a lot of hype around a lot of words, and you know, AI, you've mentioned, blockchain, machine learning, natural language processing, data science, fine. Great words, but they all existed before, using computers and creating algorithms and using, trying to create, some form of scenario analysis or predictive analytics. You know, that was there through the 70s, 80s, 90s, and it's there today. The difference is the ability to use a compute power that's just factors larger is allowing us to do hundreds of thousands of scenarios to find that needle in the haystack and create some competitive edge versus what we had before. So in the merged company, So we had some economic research. They had Janes, which for people from Britain will know as the old aerospace and defense and military information. And in that, we run events analysis. So you want economic and political risk events, and on the other side, you want terrorist-related activities. We do this in 220 countries. Natural language processing is a great way to scan the web in multiple languages and use compute power and some additional, computer-generated intelligence to scan for more events than we could do with people on the ground. So I look at it, I'm more of an augmented intelligence person. Let's use computers to augment humans like we've done for years. And our company is very focused that way, which also makes sure that your people feel that they're going to grow with technology, not be replaced by technology.
So it almost sounds as if, maybe putting words in your mouth here, that if the platform is well used enough, it almost becomes something in its own right that you can use in many, many different ways.
Right, so you start off with a product. I'll give you an example. We have a product in the US and throughout Europe growing, but not in the UK, called Carfax. It's keeping track of vehicle history reports. We now have 60 million users. The product actually was selling, for $10, $15, $25, a way to keep track of the history of your car. But once you get to 60 million users, actually the product isn't the value. The value is the data that the product created. So for any, I know people from Revolut, I mentioned to you this morning, I just downloaded that app. All my children had downloaded it. So, please take a look. I'll be there advertising today. But they have so many users now that their value proposition will shift to the data that the platform creates.
To go back to that Carfax example, what kind of data are we talking about? If it's being used, sold so cheaply, what kind of data do you use that makes it more valuable?
Well, what happens is people start keeping track of their vehicle history report, and you have 60 million of them, and 5 million of them are brand X, and brand X needs tires on month 18 and month 36. Brand Y needs them on month 17 and month 32. These ones need more oil changes. These ones have, steering alignment problems. So all of a sudden you have service history. So all the brands want to buy that. Consumers want to know it for future value. So then you have a used car platform competing with Auto Trader. You have information that banks and insurance companies want to either lend money or insure cars. You've got crime, so you've got police want to have it so they can track the vehicles and see if they show up in any of the other service centers. So you end up with this huge platform growing double digits that is growing for reasons that you didn't even create it for, because you have data and we have subject matter experts. We use technology, of course, all the web-based distribution and tools and visualization and all the other things that you
so everything becomes a data point, maybe not in a Facebook kind of way, though.
Well, Facebook, yeah, it's the same thing, The fact is, the idea of social networking to create some advertising. When you get to 1 billion users, you've got one of the best ad platforms in the world. And I think we see that with Google, we see it with Pinterest. And actually what's interesting is our automotive data in the US, we have every car in the garage going back to Henry Ford, because we collected registration data. Now you can say anybody can do that, but try going back 100 years and pulling every registration on every car. That's real content. When you put that with subject matter experts, you actually have a digital marketing feed. Nobody ever thought about that. That was an asset that was, in the garage of another asset that we bought, and at the time it was probably just a maturing asset that existed. But as content became more leverageable with technology, you create a digital ad feed driven off those that vehicle registration information. And we've been doing the same in Europe for 10 years now, collecting vehicle registrations. I think we're up to a couple 100 million vehicles. Not enough yet. You'd think it was enough, but if you want the whole of Europe to create banking, insurance, crime, and a whole bunch of other products, you need to have it all. And that takes time.
Last question, and given it's so topical, yeah. Do you see this as a very different sort of data collection from the kind of thing that Facebook has been doing? That this is, are there any similarities here?
Well, we don't have, I think the key thing is whenever you have behavioral data, do you have the rights to use it, right? We're all, in Europe, we're in a economic zone where, dealing with confidentiality and people's information, it's, right at the top of everybody's agenda. And so all I would say is if you're going to deal with anything that's behavioral related, you better have an I agree somewhere and have the ability to use the information. And that's not something I would guess on. I would know. And I think it seems like there's a little bit of guessing going on in terms of what's the ability to leverage and use the data. But we all click I agree without reading this stuff every day. I think I just did it on that Revolut app. So now they're going to know when I go on holidays, where I eat, what I shop, where, what currencies I'm converting to, and that will become their data because I've allowed them to leverage my content so I don't have to pay some FX fees. So what a great catch.
Lance, I'd love to talk for longer, but sadly our fire has died out.
Okay.
But thank you very much indeed. It's been a pleasure.
Good.
Thank you.
Thank you,
Cheers.
and thank you very much.
Thanks
and good luck.
Right.